Welcome to vTalkInsight, Risk Sentiment Daily for April 24th, 2026. Global risk tone today is pulled between a powerful AI and semiconductor rally on one side and a deepening Middle East energy shock on the other. We will unpack how that tug-of-war is shaping risk appetite across equities, credit, and real assets. Risk sentiment is best described as two-way and fragile. U.S. equities remain close to record levels, but the latest session saw the S&P 500 slip modestly and volatility hover around the high teens, signaling a more cautious backdrop than earlier in the month. Compared with the more straightforwardly upbeat tone seen just a couple of days ago, markets now look more finely balanced. Strong earnings and AI-related growth are still supporting risk-taking, yet investors are increasingly sensitive to any negative surprise from geopolitics, energy, or policy. On the supportive side, abundant liquidity and a robust U.S. earnings season, including widespread earnings beats and upgrades, continue to underpin equity valuations and credit spreads. An AI and semiconductor upcycle is adding a powerful structural growth tailwind. Set against that are clear vulnerabilities, a severe energy and shipping disruption around the Strait of Hormuz, rising oil above $100, higher for longer rate risks, and very narrow market leadership. The result is a market that is still willing to run risk, but with a much thinner cushion for shocks. The AI and semiconductor earnings boom remains the dominant bullish driver. The Philadelphia Semiconductor Index has logged a record winning streak and reached new highs, with chipmakers posting one of their strongest rallies in decades. Behind that price action sits real earnings power. Intel, Texas Instruments, and SK Hynix have all delivered strong earnings beats and upbeat guidance, citing surging demand from data centers, AI workloads, and industrial recovery, with some names seeing double-digit share price jumps on results. AI-related capital expenditure is now a macro story, not just a sector theme. Estimates suggest hundreds of billions of dollars in data center leasing and chip investment this year alone, with AI capex contributing a large share of recent economic growth. Investor enthusiasm is also broadening within semiconductors. Demand is extending beyond the obvious leaders to other hardware and memory players, while physical constraints such as limited cleanroom space and power are capping supply growth, potentially supporting elevated pricing and strong earnings well into 2026 and 2027. Robust U.S. earnings and liquidity form the second key source of support. The current reporting season shows roughly 88% of companies beating expectations, with overall earnings growth running in the low double digits despite macro uncertainty. Forward profit estimates have been revised higher across all S&P 500 sectors since late February, with technology forecasts up about 11%. That upgrade cycle, combined with stable long-term treasury yields, is being used to justify equity multiples around 20 times forward earnings. Liquidity conditions are reinforcing that earnings story. Central bank balance sheets remain ample, and recent sideways trading followed by sharp equity rallies suggests liquidity is still a more powerful force than short-term technicals. Realized volatility across equities, rates, and major currencies has dropped back toward or below 10-year averages, creating a supportive backdrop for risk assets. While credit spreads are tight and valuations leave less margin for error, the combination of earnings strength and liquidity continues to discourage broad-based de-risking. Resilient U.S. consumer and services demand is another important bullish element. Airlines and card issuers are reporting record or near-record revenues, with American Airlines and Southwest highlighting robust demand across both leisure and business travel. Premium segments are especially strong. Major U.S. airlines expect to pass through nearly all of their additional fuel costs to customers, helped by solid demand for higher-end cabins, while American Express is seeing double-digit growth in luxury retail and premium travel spending. The picture is clearly bifurcated. Higher-income households, which own the bulk of equities, are driving a consumer boom, while lower-income groups struggle with elevated prices. Even so, as long as the wealthiest cohorts continue to spend, services sectors from travel to hospitality retain a meaningful earnings cushion. There are risks if equity markets or employment soften, especially with energy costs rising. For now, though, strong services demand is helping to offset some of the macro drag from higher fuel prices and geopolitical uncertainty. On the bearish side, the escalating Middle East energy shock is the most immediate macro headwind. Persistent blockades and naval incidents in the Strait of Hormuz have halted much commercial traffic, including all liquefied natural gas tanker flows since late February. Roughly one-fifth of global LNG supply has effectively been removed from the market, while oil and gas prices have surged by around 40% in recent weeks. Brent crude has rallied above $100 a barrel, with both Brent and WTI logging multiple days of strong gains as physical supply remains tight. Inventories are being drawn down at an alarming pace, with visible stocks projected to hit record lows even if flows start to recover soon. Emergency reserves may be lower than reported, and further releases could prove difficult, increasing the risk of acute shortages over the next few months. The fallout is spreading beyond energy. Airlines in Europe are cutting flights, fuel and freight costs are pressuring corporate margins, and delays in oil, LNG, and fertilizer shipments are worsening food crises in vulnerable countries. Together, these dynamics raise stagflation risk and could quickly shift equities from a V-shaped rebound toward a more volatile W-shaped pattern if the crisis persists. Higher for longer rates and inflation are another key drag on risk appetite. Inflation remains above the Federal Reserve's 2% target, with rising producer prices, super core measures, and higher food and gasoline costs complicating the disinflation narrative. As a result, there is growing skepticism about near-term rate cuts. Some market participants now openly consider scenarios where policy rates do not fall until 2026 or later, absent a clear weakening in growth or employment. U.S. Treasury yields have shifted higher across the curve since late February, with the 10-year expected by many to trade in a 4 to 4.5% range. Investors are also demanding a higher risk premium for holding longer-dated treasuries amid concerns that future Fed leadership could be less predictable. In credit, tight spreads and stretched valuations leave little room for disappointment, even as investment-grade yields around 5% provide some comfort. This yields a challenging backdrop for duration-sensitive assets and high-multiple equities, particularly if the energy shock feeds further into inflation data. Finally, elevated concentration and narrow breadth are amplifying downside risk. Recent S&P 500 gains have been heavily concentrated in a small group of large-cap technology and financial names, with market breadth remaining thin and several major sectors underperforming. U.S. equity earnings growth is similarly concentrated, with technology and financials contributing the vast majority of profits this year, while many other sectors lag. At the same time, stock ownership is skewed, with the top slice of households holding almost all listed equities and much of the recent wealth creation tied to the AI-driven mega-cap rally. Signs of strain are also emerging in private markets. Liquidity mismatches are causing stress for some investors, hedge funds are bidding for private shares at steep discounts, and regulators have stepped up scrutiny of the fast-growing private credit space. There are early indications that market leadership could broaden, with some non-tech sectors and international equities starting to participate more in the rally. Until that broadening is more established, however, the combination of concentrated leadership and patchy liquidity leaves indices vulnerable to any disappointment in AI or large-cap earnings. To sum up, today's risk backdrop is finely balanced. A powerful AI and semiconductor earnings boom, supported by robust U.S. profits, ample liquidity, and resilient premium consumer demand, continues to underpin risk-taking. Set against that are a deepening Middle East energy shock, sticky inflation with higher for longer rate risk, and elevated market concentration, all of which leave a much thinner margin for policy or geopolitical error. Watching energy supply developments, inflation data, central bank communication, and signs of market breadth broadening will be critical over the coming weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.